Hi, welcome back to the channel. Today we're tackling a super important topic, whether you're a seasoned investor or a budding one. It's the different financing options for property, investment property in the UK. So,
let's get into it.
Let's get into it.
Right.
So, we've got five different ways that you can finance a property, buy-to-let property.
We'll start off with the most obvious one.
I was going to say before that, should we talk about why to finance it? I mean, using other people's money is one of the key differentiators for property versus any other type of investment. You can get mortgages on stocks and shares and crypto and whatnot. Perhaps you can do it, but leveraging up on that kind of investment perhaps isn't wise. Whereas investing in a property using a mortgage is quite a traditional, time-honoured and well-established way to do things. It means that, let's say you buy £20,000 worth of stocks and shares and it moves by 10%, you made £2,000. Now, you take that same £20,000 and put it as a deposit in a property that's worth £100,000, the rest of it being finance, and we'll talk about which finance to go for, then when that market moves by the exact same amount, 10%, then you're going to make 5 times more. You're going to make £10,000 worth is £2,000. So it massively accelerates your growth, your return on investment, and particularly your return on capital employed.
Indeed.
But which way to finance it? So go on, Adam, you've got 5 and we'll talk about them.
The first one is just a traditional buy-to-let mortgage. Sounds pretty obvious. Amazing how many times I speak to people and they don't realise, for example, you can't buy a rundown house with one. You can't buy a rundown house with a buy-to-let mortgage. The key thing is it has to be lettable in a lettable condition because it is a buy-to-let mortgage. So that's just something to consider. You will probably need a minimum of a 25% of the purchase price deposit. There'll be a few fees maybe included. You might have to pay for a mortgage valuation. Sometimes they're free within the product. But apart from that, that's about it really, isn't it? I mean,
applying for a buy-to-let mortgage feels very much like applying for a mortgage for the house that you live in.
Even if it's in a limited company, more or less the same.
Yeah, very, very true, limited company lending is becoming more prevalent, but again, it feels very similar these days. A few more hoops to jump through on a limited company, but not that many. 2 more and maybe another £500 to £1,000 extra in fees, potentially, not always. The things to remember on it is we get asked this again, no such thing as a silly question. How many buy-to-let mortgages can you have? True. Because it's not just based on your own personal income like your house that you live in would be. It's based on the income that the property brings in. Hence why it has to be in a lettable condition. If the survey looks at it and says this is not in a lettable condition, it's run down, then you can't get a buy-to-let mortgage on it, like Adam said.
Also, you can't buy a house with a buy-to-let mortgage and then suddenly start transforming it and turning it into an Airbnb or a HMO or something. It has to be
there are rules around these things.
You have to sign a thing that says you're going to let this on a single AST, and it will be a single buy-to-let house. So that's the first one with a few little bits of extra information. So the second one, really common way of financing is bridging loans. Okay, so a lot of our clients in the past have used bridging loans to help them buy something they basically couldn't afford. A rundown house, because they couldn't buy it with they wanted to buy a rundown house, they didn't have enough cash. A bridging loan will allow you to buy a rundown house and you'll pay that bridge off in 6 months or 12 months after you've done a renovation and added some value and you've put a normal buy-to-let mortgage on the house, right?
So things to point out there is it's still a mortgage. Some people would wrongly assume that because it's a bridging financer, you can maybe get 100% of the value because, why not? It's development. Not true. So you're still going to be limited to a percentage of the purchase price. It's possible that it could be higher than the normal buy-to-let mortgage, but generally speaking, there are some, but you'll pay a lot more for them that will potentially do 100% of the purchase price and even maybe the development. But you'll pay a lot more for that. Come on to development finance,
yeah, we come on to that.
That's one of the last ones. But a standard traditional bridging loan is a little bit more expensive per month, a little bit more expensive in the fees. You'll put your own percentage in to buy it. So let's say it's 80% loan to value, 80% is the bridging loan, 20% is your deposit, and then you will pay in cash, like you have to, for the renovation yourself, and then you will, generally speaking, refinance out of that product as quickly as you can, because the month-to-month fees are generally a bit higher.
Really high.
There are some products, like I say, that will lend you 100% of the purchase price on the idea that you're going to do the renovation. They're quite a bit more expensive. Things to watch out for: the fees, the fee in, the fee out, and then the monthly fee. So there'll be a fee, product fee.
And the fees for the whole thing are usually payable right at the start as well, aren't they?
Often,
Wrapped up
yes. One of the benefits could be that even if the fees are paid at the beginning, sometimes you just pay them. Sometimes you can have them all calculated at the beginning and then wrapped into the loan, but then don't forget you're paying interest on the fees. That's a possibility. If you it can sometimes get away with you. And the other thing to watch out, of course, is getting off the other end as quick as possible. We, generally speaking, I've used bridging finance, and generally speaking, even if I think I can get the project done very comfortably in 6 months, I'll set it at 12 months because I don't want to be rushed. After you get to the end of the bridging finance, there will quite often be a massive hike in the interest rate. And let's say you were paying quite happily 8%, and that was doable for the period when you're doing the work. Comes to the end, you can't get refinanced, something goes wrong, and all of a sudden you might be paying 12, 15, 20%.
Which is why I tell people never do a property flip with a bridging loan, because you can't guarantee how fast the house will sell.
Yeah, and you do that at your own risk. I know people do it.
It's my advice.
Thanks for that. That's bridging.
One other thing.
One other thing. Go on, Columbo.
Quite often, Columbo moment there. They can be very fast, a bridging loan lender, to give you a yes, we'll loan you the money.
That's very true.
They can be quite slow to actually release it. They'll have their own solicitors, you'll pay for them. They're twice as more complex and harder to deal with than a normal solicitor. So the actual conveyancing time will be slower than cash purchase, probably slightly slower than a mortgage purchase.
Very true. The strap line on the mortgage, the bridging loan advert will be, we can have money in your bank within 24 hours. Of course I can. I can put money in your bank in 2 hours, can't I? Anybody can. It's just you've got to answer these 74 questions before I do it. That's
it. So that's it for bridging loans.
Number two. Number three.
Number three is commercial mortgages.
So we're talking really high street banks, or just off the high street, maybe challenger banks, taking a commercial view on a property you have and lending on a commercial valuation. We're probably talking more typically about HMOs. We'd definitely be talking about commercial property, shops, lockups, warehouses, those kind of things. That's
but
commercial
for the sake of residential property,
which that's what we're generally about.
HMO most likely. But just because you've bought and converted a house into HMO won't guarantee you that it will be valued on a commercial basis. Even if you think someone else has done it recently around the corner, doesn't guarantee anything.
The idea of a commercial valuation gets bandied about a lot in property circles because it sounds very advantageous. A commercial mortgage will generally be not based on the bricks and mortar, it will be based on the yield of the property. So the income coming in times a multiplier, and what you tend to get is a increased valuation. Just put some pounds to it that they're from thin air, but let's say bricks and mortar value for an HMO might be £250,000. So the house itself, £250,000.
In the Midlands, let's say that's in the East Midlands.
Roughly. Now, the commercial valuation might be as much as
320 or something.
350. If you get a different yield, 400, somewhere that considerably higher. Now,
so people pitch them as you can
pull all your money back out of this HMO.
You'll get all your money back out, but they don't tell you can have a massive mortgage.
Well, a couple of things. So first of all, if you have a 5-bedroom HMO, it's not going to get a commercial mortgage on it. It might need to be 10 significantly converted, all HMOs.
Probably at least a 7.
Different lenders have got different rules, but it's not just a 3-bed terrace converted into a 5-bed HMO. So it's a bit more than that. So the amount of money you put into this thing is probably more. If you take a standard house and make it into this, you've got a bit of a Frankenstein house. It never quite. I like owning an HMO that I can put back to being a house if I ever wanted. That's my personal preference. The other thing is you've now got a great valuation, but two things. One, if you get a big loan on that valuation, you're going to really suffer the cash flow, and that can be something to watch out on. You think, oh, you celebrate, oh, look at this loan, look at this. And then all of a sudden you realise, actually, you're not making so much money every month. Yeah, absolutely. And landlords haven't quite twigged, hang on a minute, that percentage rate, because it's a commercial loan, is a little bit higher than I'd be paying normal buy-to-let rates, so that can take out. And then here's a big one for me. It's not necessarily, I've seen people go, I've done it myself, I've gone through all that work and effort to get a commercial valuation, and then I realised that the lender that's going to lend me that money, generally a high street bank, they're very good at moving the goalposts, having a, there's a runway to getting this thing. There's loads of questions and things that you get. Whereas with a with a buy-to-let bank, it's just, you know where you are pretty much on day one. It goes through underwriting and off it goes. The lender that's lending you, whether it's NatWest, Barclays, and Lloyds, whoever, you might find yourself with a great big valuation, but now they say they'll only do 60% loan to value. By the way, we want loan cover of 175% amortised, so actually your loan comes down to 40%. Good job you got that really good big valuation, because the loan is actually a lot less than you would have got going through a non-commercial valuation, but they will charge you higher fees and higher percentage per month. So buyer beware with a commercial mortgage. I feel like I've just rained all over that one. It can have its place.
Tell us in the comments if you've done a really good job.
If you've had a really good experience, I would tend to say the bigger projects, they're going to work better. Try and shoehorn it into a smaller HMO. You're going to be paying extra fees for not a lot of extra gain. So there we go with that one.
Okay.
Next.
Now, fourth one is harder to come by, because it requires some networking really, but it's joint ventures and maybe you've got a private investor, or you've got a joint venture partnership. Great if it's two people who singularly can't afford to do something, but together they can pool their money. Fantastic, it works. You'll need a good legal document. Make sure you're setting up with someone you trust. But you've done joint ventures before.
So. Two things we're talking about here: joint ventures and private finance. So other people's money that's not a bank or an institution. So we have clients who are partners in business, not partners in life, partners in business, and they buy a house together and they build a business together, a property business together. That works really well. Like I'd say, just definitely, like you said, make sure they've got all of the
we've got some documents in place. We've got some clients that have maybe a really close friend or family member that isn't interested in property, but will happily invest and lends them £100,000, £200,000.
Then the other side of it is, again, it's a joint venture, it's a partnership, but you've got somebody with some money who doesn't want any ownership of the business whatsoever, but they will lend you the money as a private investor. That's my favourite form of lending. Every property that I buy, almost, I've got a pot of my own cash. And that quickly runs out. People say, well, if it's so good, why aren't you buying every single house? I wish I could, I've got a pot of cash that I use myself. It's all in property all the time. And then when we find another deal and we think we'll have that, I'll go to a couple of other people that have got some money. They're not interested in investing in property themselves at all. They have in the past. They've made some good money. It's now sat in an offshore account somewhere. It buys my house. I pay them money every month. And then within a period of time, could be 6 months, could be 12 months, I put a buy-to-let mortgage on it and pay them back and buy the next one, and it just keeps churning around. It's a private mortgage.
If someone was thinking of doing a JV, or they think they've got someone prepared to lend them the money, what do you recommend is a fair percentage?
Well, negotiate it, but I don't mind paying 6, 7, 8%.
Yeah, I was going to say 7.
Yeah. I mean, paying a little bit more depending on the project. I'm lucky that I've got a good track record, and I've been using the same team of my friends now, and they provide 100% finance of the whole property. They know our model. I provide them details of the properties, but they're all exactly the same, aren't they? It's another one of those, Jess, and off we go. So there you are.
There you go. 7%, go for that. And the final one today is development finance.
Development finance. Okay, so we started to talk a little bit.
What is development finance?
We started to talk a little bit about can you get commercial finance, and we're also looking at bridging. But we're talking about here building something from scratch or taking on a big project. So even if it's
big HMO conversion,
a big conversion,
making a big
commercial to resi, that kind of thing. So again, you're back to the high street banks, challenger banks, and then some specialist development banks. What you'll tend to find, and this can be really useful for investors who have got a project like this, it's got multiple stages. You will have a stage where you've got outline plan permission, you've got an option on the land maybe, or the building that you're going to convert. You've got all of the approved detailed plan permission and building regulations signed off, and then you've got the digging the hole groundworks up to damp course level, walls up to roof plate level, roof on watertight, and then the fit out. So you've got some natural stages, and development finance will fund you up to each one of those stages.
Yeah, I was going to say, usually they'll release more funds as you progress, don't they?
So it's all pre-agreed before you get into the whole thing.
They'll come out and inspect it.
They'll inspect it at the various stages, and they'll always be just supporting you a little bit behind where you've already got. It can be really, really useful for those bigger projects.
And do they often charge you each time they come out and inspect it?
Well, not often. They always charge you in. The money in these things for the banks is and they need it to report back to their credit committee. It's the management information around it. Yes, the surveyor came around and they signed off possibly 5 or 6 times all the way through. Depending on the size of the project, that could be 1, 2, 3, £10,000. The kind of projects we do, it might be £1,000 or £2,000. If you're building a block of whatever, then it's going to be a lot more, isn't it? Development finance is useful when you're building through those stages: pre-planning, detailed planning, digging a hole, filling it up, getting the walls up, getting the roof on, getting it watertight, and the lending will support all the way through. And then maybe some senior debt on top of it, or refinance the whole thing out, and off you go. So
there you go.
We covered it. I think they are the main 5.
I think so. Big 5.
What's your favourite?
Buying cash, put a mortgage on it. Traditional buy-to-let mortgage.
So
bit boring.
I love this kind of one where we bring all the different options to the table, and you've heard them all. My advice would be, don't complicate it too much. If you can fit the simplest, easiest, if you can just buy it in cash and then refinance it with a buy-to-let mortgage, do that. The more you try and push the envelope and squeeze things out, the more fees you'll be charged. The more of your cash you can put in, the cheaper it will be for you, the more stable and steady it'll be with you. I personally, maybe I'm just a scaredy cat, I don't know. I personally prefer to do a smaller deal, all in my own cash. Now I've got no pressure whatsoever, rather than take that cash that I've got and leverage it up to the absolute hilt and do something bigger.
Yeah.
I will leverage it once I'm done, stick it over my shoulder and keep doing the same thing again. But let us know in the comments if you think I've got it wrong. Maybe I could be moving quicker. Maybe I'd be a richer man if I had been. But anyway. Bye for now.
Yeah.
Thanks for listening.
Subscribe. Feel free to click the link in the bio if you want to talk to me about property investing, property management, financing.
All those things. Hopefully you're liking the content. Bye for now.
Cheers.